Welcome back to Financial Management. I'm Miriam, and I'm going to walk you through Lesson 5, Part 1, Saving, Investing, and Speculating. Saving, investing, and speculating are three different ways to try and grow your money. Each of these methods works a little bit differently and has different benefits and risks.
Every successful investor must begin by understanding the difference between saving, investing, and speculating. If you get those confused, you run the risk of losing a lot of money. Let's start with saving. Saving can be defined as the process of setting money aside in order to make a purchase a short time in the future, typically under 3 years. The most important element when it comes to saving is the safety of your money. You don't want the value of your savings to fluctuate because you'll need all of it to make your purchase. There are several options available to help you save money: savings accounts, money market accounts, and certificates of deposit, for example. Unfortunately, as a trade-off for protecting your money, saving typically pays interest at a rate that is just a bit higher than inflation. If you want to earn more than that, you'll have to look to investing. Unlike saving, investing is a long-term process. It often involves committing a portion of your money to owning a share of a business, with the expectation that you'll receive a higher return than inflation. The most important factor in investing is the growth of your money, and there are many ways to invest, with stocks, bonds, and real estate being the most popular. However, once again, there's a trade-off. While investing typically offers better returns than saving, it also carries more risk, as the value of your investment bounces up and down, at least when looked at in the short term. To be a successful investor, you must invest your money for at least 3 years. That's because, over longer periods, the value of your money will appreciate enough so that even if the value of your investment falls over a short period of time, it will still be higher at the end of the period than it would have been if your money had been sitting in a savings account. But what if you need to grow your money quickly? That's where speculating comes in. Speculating involves putting your money at risk with the hope that you will earn a high return in a short period of time. Day trading is a good example of speculating, where stock trades are opened and closed in a period of minutes or hours. Speculators can win big, but they can also lose everything. So, to sum up, save to protect your money, invest to grow your money, speculate to gamble your money.
So to recap a bit, there are several different ways that you can save: certificates of deposit, savings accounts, and under your mattress. We'll talk about each of these more in the next video. What's important to note now is that while the savings options may bring you less possibility of return on your money is safe from outside influences. No matter what happens, you will always earn the slow and steady interest on your money in a certificate of deposit or in an interest-bearing savings account. While there may be penalties for pulling your money early from a certificate of deposit, the money in either of these accounts is more accessible to you should you need it than funds that you have invested or speculated. Investing, such as in stocks, bonds, real estate, or a 401k, falls in the middle for both risk and return. Depending on your investment and the market, there can be higher low risk with higher low returns. The money you use here should not be money you need to pay your bills, but it could be money that's part of a long-term savings plan or retirement plan. Speculating your money should only become an option when you can afford to lose that money. It is no different than going to Vegas with $300 that you are willing and able to lose. You should only speculate money that you do not need. Make sure that you don't need that money to pay your bills or for your long-term savings plan. The easiest way to start saving is to open a free savings account that is attached to your checking account. There are several other benefits to doing this too. If you have direct deposit with your employer, which is when your paycheck is automatically and electronically deposited into your checking account on payday, then you can tell your bank to take a certain dollar amount out of the incoming deposit and put it directly into your savings account automatically. If your savings account and checking accounts are linked in a specific way, you can avoid overdraft fees. There's a setting that automatically moves the money from your savings account to checking account if you're about to overdraft. This helps you avoid the overdraft fee, which can be as high as $30 to $35 per transaction. A savings account that has money in it will make lenders, including your bank, more likely to give you a credit card and a lower interest rate on that credit card. This chart is in your packet of handouts. Feel free to fill it in as we go. Saving is the process of setting money aside to make a purchase in the near future, usually under 3 years. Bank accounts like savings accounts and money market accounts are 2 examples of this. The pros are that your money is safe. This is not a risky option, and you can easily access your money. Generally, in savings and money markets accounts, there are no fees to withdraw. There are in a certificate of deposit. The downside to this is there's not a super high interest rate. It's just a bit higher than inflation, so your money isn't growing very fast. Investing is a long-term process. You're committing a portion of your money to owning a share of a business, and the goal here is for your money to grow. Stock, bonds, and real estate are all examples of investing. The pros here are that you'll usually see a higher return or interest rate than inflation on a savings account. However, you generally need to be able to keep your money in an investment for at least 3 years to see that higher return. And there is some increased risk. The value can bounce up and down depending on the market. Speculating is putting your money at risk with the hope that you will earn a high return in a short period of time. Remember, this is a gamble. Day trading is an example of this. You can win big, but you can also lose big. This is very risky and you can lose everything. Thanks for watching. In order to get credit for completing this lesson, submit the Lesson 5 Part 1 assignment in Google Classroom.